Welcome to Module 2, Lesson 1, Discounting Cash Flows, the time travel of money. So this lesson has 3 learning objectives. What does it mean to discount cash flows? Which factors determines the discount rate? And what should your discount rate be? I remember my dad telling me when I was a kid how his parents once gave him 25 cents to buy candy. For me, just being old enough to understand the concept of money and having bought enough candy for the very first time, Down turned into disbelief when he listed how much candy he would get for just a quarter. I asked him how much a quarter was worth back then, and to my frustration he said, well, 25 cents. But he added you could buy more for a quarter back then. If only I paid attention, I've got my very first valuable lesson in valuation and the time travel of money. My intention for this lesson is to break down and explain what discounted cash flows are and how we determine the discount rate. In Module 1, we learned that when we buy a stock, it generates a cash flow. And as you also saw, it doesn't matter if it's a form of dividends or not. So let's just assume that over the next 3 years, a stock will generate $100 each year. You might be thinking that the value of the stock today is $300. I mean, after all, you collected $100 thrice, right? Well, one thing is that we need to factor in inflation. Say inflation is 2%. As you can see, today the value of those $100 after 3 years is only worth $94.23, and the value of the $100 increases as we go further out in time. So in reality, the value of our stock is not $300, but rather $288.39. As we increase inflation, you can see how the value today is decreasing, and as we decrease the inflation rate, you can see the opposite. In the example, the concept of discounted cash flows can be compared to purchasing power. A quarter when I was a kid could buy you less than when my dad was a kid, and it probably comes as no surprise to you that today a kid can buy even less candy for a quarter. So by this, we're already discussing the first among many variables to determine the right discount rate to use. Here in Module 2, I'll provide you with the first half of the key to understanding valuation. If you remember from Module 1, you were first introduced to valuation, and namely that the intrinsic value of a stock is the discounted value of all future cash flows. My plan is to explain the part about discounting in Module 2 thoroughly, and then in Module 3, we will in-depth explain how to estimate the cash flow of a stock, which will give you the final piece of the puzzle. Okay, so we learned that inflation has an impact on the discount rate. The higher the expected inflation is, the higher the discount rate you should be using, since the amount of dollars in the future will buy you less. Typically, you will be using the same discount rate throughout the period, in this situation 3 years. It might seem counterintuitive considering that you'll be discounting future cash flows where the inflation is not expected to be the same. For instance, you might have read that the inflation a year from now is expected to be 2% and inflation 2 years from now is expected to be 3%. How should you include that, you might be thinking? Well, first of all, inflation is only one among several factors to include when determining the discount rate. And second of all, it's implicit that there will be some uncertainty when you're talking about the future. For instance, though there might be a good argument for 2% inflation a year from now and 3% inflation, say 2 years from now, it's still uncertain. Therefore, I suggest that you use the same discount rate for simplicity. Also because you want to find investments fundamentally priced cheaper than their intrinsic value. If you need to change your opinion based on tweaking the discount rate here and there, you're likely not buying the stock at a sufficient discount anyway. Which other factors aside from inflation determine where we should use a high or low discount rate? Well, the next factor I'd like to talk about is opportunity costs. The concept is very simple, and you incur opportunity cost all the time. For instance, if you work 1 hour less to be with your family, you have a given monetary cost attached to that hour. Say that you after tax could have made $20. Then it's up to you and your financial situation if it's worth $20 to be spending 1 hour more with your family. Consider the opportunity cost for a college student. For instance, if you decide to go to college, you can't work full-time at, say, Starbucks at the same time. That is an opportunity cost for you. However, you will likely argue that you can expect to make more money in the future with a college degree than without. So to get the full scope of this decision, one must also factor in that the 4 years as a college student are happening right now and therefore should be discounted less than cash flows in the future. As you can tell from the examples, you always incur opportunity cost whatever you choose to do. You need to use the same train of thought for determining the opportunity cost when estimating the appropriate discount rate. The key determinant for you to look for as a stock investor is the interest rate, which is reflected in the 10-year Federal note. For instance, if the return of a 10-year Federal note is 5%, I would use a higher discount rate than if the return was 2%. The explanation for this is straightforward. If you can get 5% return risk-free, you would require an investment opportunity to be better as an investment object than if you could only get 2% risk-free. Keep the term risk-free in mind. Considering the US to be my home market, I also consider the US Treasury to be risk-free. The US government will have to default for not to meet their obligations. Now, this is not the same as it's 100% impossible. I guess nothing here in life really is, but to me, the Treasury rate in the US is the best indicator of a risk-free investment. So you might be thinking, what if you were living in India or living in Australia? Should I also be using the US Treasury rate, or should I be using a domestic rate instead? Well, we have to go back to the term risk-free. If you consider either the Australian or the Indian government to always meet their obligations and thereby be risk-free, well, then that is what you should use. It's always a question of opportunity costs. Regardless of where you live, I would suggest to be looking very broadly in developed economies to determine the impact on interest level on your discount rate. That is not the same as saying that less developed countries will by definition default, but you incur other types of risk, including currency risk, that might distort the overall intrinsic value calculation. The third factor I would like to discuss when determining the intrinsic value of a stock is uncertainty. Having been a part of a startup space for quite a few years, I couldn't help noticing how many people that wanted to start up a business around an app. Because of my background as an investor, I'm also asked about the valuation of the company. The startup space is perhaps the field where you'd be using the highest discount rate. And while you're likely watching this course to better value public companies, I think you'll find the example of startups to be valuable. When I'm asked, it's typically because the founder of the company are considered raising capital, or perhaps has already been approached by a venture capitalist asking for the valuation. You'll probably not be surprised to learn that the founders and the venture capital people usually don't agree on the valuation, and it creates a lot of friction. The reason for this is simple. If you're the founder of a company, in your mind, you're creating an app that will make a big impact on the user's life. You're probably also convinced that you have what it takes to go from a simple idea and to be going really big. Now put yourself in the shoes of the venture capitalist who are speaking to thousands of talented entrepreneurs each year. Even though he thinks the app is a great idea, he's facing a lot of doubts. Or in other words, he's facing uncertainty. He might think the idea is great, but are unsure that the founder can work with the right programmers to have it developed, and he might even be unsure that the business model doesn't even work. So the founders might project that the app will generate $10,000 every year the next 5 years. Even though the venture capitalist might agree with the projections, the certainty of the cash flows materializing is typically vastly different. It's not uncommon for a venture capitalist to use a rate of 25% or even up to 40% when discounting back cash flows. As a stock investor, estimating the intrinsic value of a stock, you'll need to take one step back and consider these uncertainties. Do you expect the cash flows from the company you're analyzing to be stable in the future? For example, when analyzing a company like Coca-Cola that has a strong track record and stable numbers, and even though we never know what the future will hold, I would argue that for the foreseeable future, consumers will still be buying Coca-Cola's products. While the comparison between a startup creating apps and Coca-Cola might seem like an extreme example, you would see why you would be using a very company-specific discount rate. Next, the actual discount rate that you're going to use. In this lesson, you were taught 3 different factors: inflation, opportunity cost, and uncertainties. For listed stocks with at least a few billion in market cap, I'll typically use a discount rate between 8 to 17%. Inflation and opportunity costs are not related to the specific company and don't change that often. What I would suggest is to get an overall picture of the 2 factors as they tend to correlate. The reason for this is that when inflation is high, for instance 4 to 5% or higher, the central bank typically raises rates to fight inflation. However, as you have just learned, a higher interest rate also means higher opportunity costs. If the inflation and the opportunity cost are low, generally less than say 3 to 5%, I would typically use a discount rate that is at the lower end of the interval of 8 to 17%. If it's higher, I would typically add a premium. For instance, if I can get 5% on my 10-year federal note, I would add perhaps 1 or 2% to my discount rate, and if the interest rate were higher, I would add an even higher premium. When speaking about and quantifying uncertainties, it's very company specific. If I again should mention Coca-Cola with its historical performance and the expectations for the future, I'll use a very low number from a discount rate, perhaps even 8%. If I, on the other hand, should value a company with declining earnings, massive debt, and a product or service I didn't believe to be sustainable, I might use a rate of 17%. For this reason, for this lesson, I've been as specific as I possibly can. But even something that appears as quantifiable as a discount rate is more an art than a science. It seems more contradictory when you are making calculations, but the calculations are, as you will see in Module 3, nothing more than the assumptions you apply. For instance, you might argue that if the interest rate changes from 2 to 4%, it would have a different impact than from 4 to 2%. And again, it would be different if it has occurred overnight or gradually over 18 months. What I would suggest is that you use a discount rate in the 8 to 17% interval as a starting point, and then use the 3 factors from this lesson to determine whether you should be using a high or low discount rate. Remember to make sure that you only purchase stocks significantly below the intrinsic value, regardless if you should be using a slightly different discount rate.